What's up, everybody? Welcome back to my channel, Mortgages with Mike D. If you're new to the channel, I'm a licensed mortgage advisor, and my goal is to help future home buyers, current homeowners, everyone in between better understand the financing options when it comes to real estate. And ultimately, I just want to make sure everyone watching is just better informed so they can make a sound decision when it comes to buying, investing, selling real estate, whatever the case may be. So in today's video, we are going to be talking about adjustable rate mortgages, also known as an ARM. And before we dive into the video, we're going to kind of break down what an ARM is, how it works, and are they actually bad? So as I said, an ARM stands for an adjustable rate mortgage, and it basically is what it sounds like. So unlike your standard traditional fixed rate mortgage where you lock in an interest rate and your rate never changes, with an ARM, your interest rate is variable. Therefore, it's going to change every so often. Yes, I know the idea of an ARM is scary, and a lot of people have a pretty bad negative perception whenever they hear the term ARM, but it's important to understand today there are a lot more safeguards and guidelines that are put into place and ultimately to help protect the consumer. Therefore, they're not ever put in a terrible situation when that rate does eventually adjust. So again, before you want to move on to the next video or hop off the screen, just stick around and understand how an ARM actually works and why it's not as bad as you might think. So just like your standard typical mortgage, ARMs are generally for a 30-year term as well. They don't have to be, but that's how they're most commonly structured. And what you'll likely see, and I'll put it on the screen somewhere here, is a 3-1, a 5-1, 7-1, 10-1, and more so today, what we're seeing is 3-6, 5-6, 7-6, and 10-6. What this really means and what it really spells out is how long your initial or introductory rate is fixed for, and also how often your interest rate will actually adjust. For example, let's start with a common 5-1 ARM. So all that means is the interest rate that you lock in, let's say you get a 3.5% interest rate, your interest rate will stay at 3.5% for 5 years. Now, after that 5 years, the 1 in the equation, so the 5-1, the 1 represents how often your interest rate will adjust. So that means that your rate after the 5-year mark will now adjust once every single year for the rest of the term for that mortgage. And very similar put, with a 5-6, you might be thinking, well, does my rate adjust every 6 years? No, it's all the 6 means is your rate will adjust every 6 months. So instead of your rate adjusting once a year with a 5-1, with a 5-6, after the fixed period is up, your interest rate will then adjust twice every single year for the rest of the term. So you might be thinking, what dictates or what determines your interest rate when you're going through the adjustment period? There are really two main components that basically calculate what that new interest rate is. The first is your margin, and the second is the index. So let's start with your margin. So your margin will be spelled out in your original loan terms, and that piece of the puzzle will actually be fixed. That will never change. So for example, let's say your margin for your specific loan is 2.5 or 2.5%. The other component, as I mentioned, is the index in which your specific loan is tied to. Back in the day, there were quite a few different indexes in which your specific loan could be attached to. Nowadays, we're generally seeing the index that's being used for these mortgages is the SOFR, or the SOFR, and that stands for the Secured Overnight Financing Rate. It's important to understand too that these indexes, like a lot of other things can change on a daily basis. So, it's important to kind of follow the index and kind of see what's going on, especially as you're getting closer to your adjustment. Now, to quickly explain how these two components make up your new rate, they basically just add the two together. So as I mentioned in the example, if your margin is fixed and when you acquired that loan, it was 2.5%. Whatever the index is at that point in time when your rate is set to adjust, they just add the two together. So let's say at that point, the SOFR index is at 1% for simplicity purposes. Your new interest rate will be the 2.5 plus the 1%. So that makes up a new rate of 3.5%. And it will basically just repeat every time your interest rate adjusts. So it will stay 2.5 as your margin, and then whatever the index is the following year or following 6 months when your interest rate is due to adjust. Now, one of the most obvious questions or concerns is, well, will my interest rate just go through the roof when it does eventually adjust? Or, these just sound like a scam, or I've heard horror stories in the past. And yes, a lot of those horror stories in the past were horrible, for the lack of a better word. But as I mentioned earlier, there's a many more just protection in place today where the consumer is going to be protected. There's more guidelines that are available and exist nowadays because we've learned from the mistakes in the past when adjustable rate mortgages weren't the best or most transparent loan programs that were out there. So to answer the question, well, will my interest rate just astronomically increase when it's set to adjust? The answer is no, because within your loan terms that you sign at the time that you acquire the new loan, there are something known as caps. Okay. And this basically just means that your interest rate cannot exceed a certain threshold. And I'm going to put something here on the screen as well to kind of show you how these caps look, because there's going to be 3 digits, kind of like what we saw before. Instead of 2, it's going to be 3. So you're going to see a number slash number slash a number. And I'll explain really quickly what these actually represent. For example, you might see 525, you might see a 225, and you might see a 226. These are some common examples that you may see in your loan terms. Now, all these numbers represent something different. So the first one, let's start with the 5 here. That represents the maximum amount that your interest rate can increase during its first adjustment. So with the running example of 5 years, once those 5 years are up, your interest rate cannot exceed 5 additional percentage points. Okay. Now the second number, so the 2, what that represents is your interest rate cannot exceed a full 2 percentage points during periodic adjustments. So every time you're now adjusting every year or every 6 months, it can't go up by a full 2 percentage points. So again, you're kind of protected there. And then finally, the last number represents, so let's say, a 5 again. What that means is your interest rate at your introductory rate that you locked in when you acquired the loan cannot exceed that last number. So 5 cannot exceed full 5 percentage points over the entire life of the loan. So as you can see, there are some safeguards that are put in place here to ensure that your rate just doesn't jump 10 percentage points, after your rate does adjust. So there are additional layers of protection here to make sure that you don't have that payment shock and your payment just astronomically increases. So another common question really quickly is, you might ask, can my payment go down when the rate adjusts? And the short answer is yes, although it may not be common. There might be a period where, rates are historically low. However, there also is what's known as a floor. So your rate can't just go down to 0% or a negative percentage point. And that floor is more often than not equal to the margin. So with the running example again, we said that the margin for that example was 2.5%. So even if that index goes to like 0% or a negative percent, which may not ever happen, if that were to happen, though, your interest rate cannot be lower than whatever that agreed upon margin number was. So finally, you might be asking, well, why would I even consider an adjustable rate mortgage? Wouldn't I much rather just have the peace of mind of knowing that my interest rate will never adjust with a fixed rate mortgage? I can just have an interest rate for 30 years, 15 years, whatever it is, and I don't have to worry about my monthly payment ever changing and increasing, because no one likes to add additional expenses. So it's nice having that peace of mind of knowing that your interest rate isn't going to change and your monthly payment's not going to increase. Although it's a good question, there can be a variety of reasons of why an adjustable rate mortgage might be advantageous. The first reason is because oftentimes the introductory rate, so the introductory rate again is if you're in a 5-1 ARM, your interest rate is still fixed for those first 5 years. And oftentimes that introductory rate is usually a little lower than it would have been if you just locked in on your traditional 30-year fixed rate. So the savings, in interest, depending on the size of the loan, could be significant. And it's something to consider, especially if you know your hold time of the house, which is kind of reason number 2. So if you know going into it that you're not going to own the home for no longer than 5, 7, or 10 years, it might make a ton of sense to get an ARM, because your interest rate, you already know it's going to be fixed for a specified amount of time. So if you sell the property before the interest rate ever adjusts, it's really little to no risk in that sense, right? Because you're never actually experiencing or being impacted by that adjustment. So if you already know going into it, you already have specified goals and plans, it's another reason where it can make a lot of sense, because you'll save likely a good amount of money, again, depending on the size of the loan. Finally, whether it's an investment or a primary residence, it also just comes down to the numbers, right? So you can really just run the numbers on a worst case scenario, right? So if you know that the interest rate can't exceed that certain threshold that we talked about earlier, you can just run those numbers and see what that, estimated monthly payment will look like. And if it doesn't scare you, if it doesn't bother you, if it's an investment property, if, the income maybe at that point you project it to be that much greater, it actually might not be a negative impact towards you, or for whatever your risk tolerance is. If it's a primary residence, again, you might not be so nervous about that potential improvement, even at worst case scenario when it comes to your rate adjusting, because you might say, well, I'm going to be making more money at that point in time. I know I have, some promotions coming up in the future. So that's something else to also kind of factor into the equation when, determining if an ARM makes sense for you or not. At the end of the day, it really comes down to the numbers, but it also comes down to your comfort level and overall risk tolerance, because it's not for everyone. That's just the honest truth. Even if it makes financial sense, some people just love the peace of mind and the level of comfort that they have with knowing I don't ever have to worry about this payment dramatically going up or really increasing at all. So it's something that's available, an adjustable rate mortgage. And again, it might make a ton of sense for some folks out there, but at the end of the day, it really is important to speak with an expert when you're evaluating different loan options. That way they can weigh all of the pros and cons with you, so you can understand, well, is this something I even want to consider? Because it might not be something that you have even thought about going into the home buying process, and your loan advisor brought up the idea of an ARM, and it might be interesting, it might make sense for you. At the end of the day, make sure you're just weighing all of the pros and cons when making a decision, because ultimately everyone's situation is different. So what might make sense for someone else might not necessarily make sense for someone else. So I hope that you enjoyed this video. Hope you found value. Again, Please like and subscribe if you haven't subscribed already. It would really mean a lot, and we will see you on the next video.